Taking Stock on Bloomberg, I'm Pimm Fox. Now, the business of technology, from social media to smartphones, it seems to be dominating the conversation everywhere. But what about the reality? Is high-tech a good bet for investors right now? My next guest, Paul Kedrosky, he is the creator of the blog Infectious Greed, and he is also a Bloomberg contributing editor. Paul Kedrosky, good to have you with us. Tell us about Facebook. Tell us about social media. The valuations, for example, Facebook, $50 billion, $52 billion. Can we spell bubble all over again?
No, you know what? As much as I'd love to say that, it's I guess I enjoy calling a bubble as much as the next guy. I just don't think we're there. I mean, this is a fantastic company that's growing better than 100% year over year. Is ahead of where Google was at this point in its young history, and is valued accordingly in the private markets, albeit in the private markets. So if you don't have the same liquidity that you did with respect to Google, so I suppose you could argue there should be some illiquidity premium here. But nevertheless, I'm not surprised by the value whatsoever. As a matter of fact, in many ways, it wouldn't surprise me to see it tick considerably higher before we hit public markets, which in all likelihood will be sometime before April of 2012.
But the fact that it's a private company means that we don't have access to any of the real details as to the financial workings of the company. Is it possible that Facebook ends up just like MySpace?
Sure. I mean, the story of technology is these flash companies that come zooming in, burn brightly, and then disappear. The question is whether Facebook, unlike MySpace, has built a platform that's sustainable. Is it a Google or is it a MySpace? And my argument right now, and again, I'm not some huge Facebook booster that has taken over my life, but I see the way it's transformed, the way so much is happening in the economy and so much is happening among individuals right now, and it's generating revenue doing it. So, let's say this year it does $2.5 to $3 billion in revenue, which is the kind of numbers that are being tossed around, from 900 million in 2009. The kinds of valuations we're seeing, while not exactly cheap, aren't particularly far off the kinds of numbers you'll see for a typical software as a services company like a Salesforce.com or others. That's what you pay for a leadership software as a service company right now.
Paul, if you take a look at all this social media, it's got to travel on some kind of network, and one of the companies at the heart of the network is CISCO. Now, CISCO's shares, they've been battered recently because of some estimates that the company released having to do with its future results. Also, gross margins coming down a little bit less than many analysts had expected. What are your thoughts on CISCO, and is it a value stock?
It's an all value. It's the only appeal in the stock right now is that it's a value stock. In many ways, CISCO, while it should be a beneficiary of what's inevitably happening in terms of a new build out in sort of the global backbone of pipes, if you will, in terms of transporting bits around the world, which was really built out in a major way in the 2000-2001 time frame at the end of the telecom bubble. CISCO is kind of badly positioned right now from a product standpoint and isn't doing particularly well head-to-head against some of its larger competitors, or some of its largest competitors like Juniper and others. And so the story now from CISCO is much more of it's not a share gain story, it's not a big growth story, it's really a value story. So you look at it and you say at 14 times-ish earnings, trailing earnings, is it appealing? I think it is fairly appealing in here, in particular looking forward, and say it does, 20-ish, 18 to 20% growth year over year on earnings. Would you pay that kind of multiple for what really amounts to a value technology stock? It's not going away. It's going to continue growing a little faster than the market overall, just not as fast as some of its faster-growing competitors. So I think it is appealing from a value standpoint in here.
Now, Paul, next week we're going to get the results from Hewlett-Packard, and Hewlett-Packard introduced its version of a tablet computer into the marketplace. Is this too little, too late for HP?
You know what? I just love all the competition in the tablet space. There's something like 60 last time I checked. So the only way you can love HP here is if you believe that a $700 tablet is going to compete effectively against a tablet at $500, which is where the iPad sits and has a much larger footprint. And you also have to believe that the market's prepared to support not just one operating system, iOS on the iPad, not just two, Android, and not just three, Windows 7, a fourth one, WebOS from HP, at a higher price point. I don't buy it, so I think it's got trouble.
What about the applications that run on all these devices, whether they be smartphones or the iPad? Is that where the real money is, in developing apps?
Well, there's fantastic money in the hardware itself if you're at the top of the market. Apple's cost on an iPad is something like $215, $220 if you look at a component breakdown, and they sell it anywhere from $500 to $680, and all of that goes straight back to them because so much of it's through the store. So it's pretty great margins for hardware. But nevertheless, software is pure margin, and the cost of developing these mobile apps has come down dramatically, even in the last 2 years as new kits have come out to make it much, much easier for developers to launch products. And you see people now launching new apps with virtually no investment. So the entrepreneur owns the whole company and quickly ramps up to a couple of $1 million in revenue right back into their own pocket. It's not going to go public, but these are great corner store software businesses. So
if these are great corner store software businesses, does this mean that angel investors are just dying to spend money on them?
Yeah, it's perfect for angels because they're scaled appropriately. If I want to put in $25,000 to $200,000, that's the kind of money that these companies need. If I'm sitting there with $300 million burning a hole in my pocket as a large institutional venture firm, and I want to write a $6 million check, I got nowhere to put it.
Paul Kedrosky, Bloomberg contributing editor, thanks very much for your insights on technology.